is Boom Bust, and these are some of the stories that we're tracking for you today. First up, Europe's in an economic depression, and things don't seem to be getting much better. We look into the factors contributing to this, and if there's any hope for the continent coming out on the other side. And while Europe's Great Recession looks worse than it did in the 1930s, not everyone believes that the continent is down for the count. Boom Bust favorite, Mr. Jim Rickards, is on the show today, and he's sharing with us his optimistic thoughts on Euroland. He's kind of alone, but they're optimistic. Then RT correspondent Manila Chan is sitting down with me later in the show to talk about Atlantic City. So can the once glamorous gambling destination regain its past glory? We're looking into it, and it all starts right now. Our lead story today, Europe and its non-existent growth. The Eurozone has been in a depression since the financial crisis. Economic growth within Euroland has been much worse than in the U.S. as well. And as economic growth in the second quarter of 2014 came in at zero, Europe doesn't seem to be breaking out of this depression anytime soon. Back in 2010-2012, Europe had a very serious crisis known as the sovereign debt crisis, which it addressed by having the European Central Bank offer a debt backstop to every country. That caused borrowing costs to plunge, removing fears that a country would default and be forced to leave the common currency. Now, for liquidity, that looks good thanks to the ECB, but the economy, it still hasn't grown, which it needs to do. That's really important. And sadly, aside from this, nothing else has really worked. The ECB has let loan growth and inflation plummet, and countries are still very much employing austerity in one form or another. The employment situation in Europe is much worse than the U.S. as well, and with mass unemployment, inflation on a downward trend, and stagnant industrial production, economists like Paul Krugman worry that Europe is turning into Japan. Japan has spent more than 20 years in a deflationary depression, and with its aging population, Europe also has similar demographics to Japan. The ECB has deployed tools to increase the liquidity, but the Federal Reserve can do much more to avoid an economic depression than the ECB can. An example of this would be very simply quantitative easing. We all know about QE. And of course, the ECB, unlike the Fed, has a primary mandate to maintain price stability, which it defines as 2% inflation per year. So it's not required to achieve low unemployment. However, as Boom Bust producer Edward Harrison has pointed out, the ECB also has a responsibility to, quote, support the general economic policies in the Union, with a view to contributing to the achievement of the objectives of the Union. These include full employment and balanced economic growth. Now, that quote, that comes directly from the ECB's website, but even with only one primary, and I mean primary mandate to handle, the ECB hasn't been meeting its 2% per year obligation. So basically, things look bleak in Europe. So is Mario Draghi in denial? Perhaps, yeah, maybe he is. But I think Matt O'Brien at the Washington Post put it best when he wrote, Europe hasn't recovered because it hasn't led itself. Too much fiscal austerity and too little monetary stimulus have instead put it more than halfway to a lost decade that's already worse than the 1930s. You just heard me say that Europe is in trouble. And economically speaking, European countries are far worse off than the U.S. today. But our next guest doesn't necessarily agree with that. Boom Bust fave Jim Rickards is bullish on Europe's political cohesion and nowhere near as downbeat on its economy as many people are. Jim is a noted economist and author, and I first asked him to explain why Germany's economy contracted in the second quarter. Here's what he had to say.
Well, what's happening in Germany, Aaron, is happening all over the world. Germany's economy contracted, as you said. Italy has already contracted. France has 2 quarters in a row of zero GDP. The United States, in the first half, we did not even grow 1%. It was down a lot in the first quarter, up a lot the second quarter, but a lot of that was inventories, and if you adjust inventories, make it look more like final sales, growth was less than 1%. And China is slowing down, and of course, Japan fell off a cliff. So if you look around the world, it looks like we're going into a global recession, except I would say this is a continuation of the global depression, which began in 2007. You know, we've done interviews in the past where I say the way to understand it, this is not a normal recovery, a normal business cycle. This is a depression. Now, you can have growth in a depression. It's just this below-trend growth. You never get back to that sort of 3–4% growth that you're looking for. It's kind of 1–2, which is what we're seeing. But you can have multiple recessions, technical recessions, inside a depression. That's what we had during the Great Depression. We had 2 recessions, 1932 and then again in 1937. So it looks like that's happening again. This is a global slowdown.
On that note, you know, this was before the sanctions on Russia were even applied, what's happening in Germany and Europe. So do you think economic sanctions will dampen the economy in Euroland and the UK even further?
There's no question about it. It's a very good point. Look, the sanctions are supposed to be political. This is primarily a financial war between the United States and Russia. I think that's the right way to understand it. Europe is being dragged along kind of against their will. The U.S., you know, they're all NATO, not all, but a lot of them are NATO members. They feel they've got to support the United States. They may not be happy with what Putin's doing in Ukraine and Crimea, but, you know, it's just not a core interest for them. What they want is to make sure the natural gas keeps flowing through Ukraine. So there are geopolitical reasons for this, but there's no question that the impact is another drag on growth. So we have all the drags that we just discussed all over the world, and now we have a new impediment to growth. And then, of course, it's just a matter of time before the China credit bubble collapses. And then the U.S. is not too far behind in terms of our stock and housing bubble. So this is a setup for, you know, at best, a continuation of the depression and a technical recession. But at worst, maybe, you know, markets breaking, something more like 2008.
Jim, do you see Europe escalating its sanction regime or letting the temporary sanctions just expire over time?
I see Europe doing as little as possible. Look, the relationship between Germany and Russia is very strong. Remember, Angela Merkel grew up in East Germany at a time when it was part of the Soviet Empire. Vladimir Putin was a KGB officer stationed in Germany. He speaks German, she speaks Russian. They've got a lot going on in terms of the Nord Stream pipeline. I mean, there's no more kind of natural alliance in the world than Germany and Russia. Germany is a technological powerhouse. Russia is a natural resource powerhouse. Germany needs the natural resources. Russia needs the technology. So that's kind of a match made in heaven. So, look, Merkel's going to do what she has to do publicly. She's got to go along with the president. Bear in mind, Obama's the one who tapped her phone, not Putin. Mm-hmm. So I think the German-Russian connection is very strong. But, yeah, there's a little bit of posturing. But I think Europe will do as little as possible.
Now, Ed Harrison has been telling me to watch Italy with its terrible demographics, high debt load, and zero growth as a key battleground in Europe. So why does Italy even matter, Jim?
Well, Italy matters. It is one of the largest economies in the world. By the way, they're 4th or 5th in terms of the largest gold holders in the world. I tend to think of the European gold as all the members of the Eurozone combining their gold into a total stash of over 10,000 tons, which is more than the United States. But if you take the members individually, Germany is the largest, but France and Italy are right behind. So Italy's a major gold power, very large economy. By the way, I love Ed's analysis. I read it all the time. I think he's one of the best. But my advice for Ed is actually go to Italy and look around, because what you find, you know, Italy is notorious for the underground economy. So yes, maybe the demographics are not all in their favor, but there's a lot of unemployed youth labor that can be brought back into the workforce. There's a lot Italy can do to, you know, help promote exports. You know, of course, tourism is a very important part of it. So I think Italy's never as bad as people think, mainly because, well, largely because of the underground economy.
I like that, and maybe our show will send Ed there. I know he's smiling right now hearing you say that, so thank you, Jim. Now, you've been bullish on European institutional cohesion, but what about the economy? Where is it headed?
Well, look, clearly it's slowing down. Whether the whole Eurozone goes into recession is a little bit academic. The major members are either in recession or verging on that in the case of France and Germany. So they're slowing down, but the whole world is slowing down. So I don't think what we're seeing is unique to Europe. Where I give Europe credit, the ECB has better monetary policy. I like to say Mario Draghi is the only central banker in the world who actually understands central banking. He knows that you're supposed to, talk little and do less. The people at the Fed can't shut up. There's always a governor or a president giving a speech every other day, confusing people, contradicting themselves, et cetera. So U.S. is a mess. But I think Europe does it right. So they've got a lot of gold. They've got a much more sound central banking policy, and they've got a lot of assets, including Chinese capital. Chinese capital is pouring into Europe because the Chinese want to get away from U.S. dollars. They've got multiple trillions of dollars of U.S. dollars denominated securities, so they're trying to diversify. So Europe has problems. There's no question about it. But my point is the whole world has problems. Japan fell off a cliff. The U.S. had a terrible growth in the first half. So you look around. Russia's slowing down. Russia's a very large economy also. China. So these problems are worldwide. Europe is not going to escape the world, but I think fundamentally they're doing a lot of things better than the rest of the world.
Jim, I'm interested in the political aspects of all this. So arguably France, that's now in the periphery, and austerity-committed Finland has seen its economy stalled. So do you think this tips the scales against Germany politically?
No, I think Germany is still politically, they're still the powerhouse of Europe. They're still the leader of the Europe. Look, Germany wants the euro. And actually, the rest of Europe wants the euro. The politicians complain about the euro in places like Greece and Spain and Italy, and then the academic economists, people like Krugman and Stiglitz and Rubini and others, they say you ought to break out of the euro, go back to your old currency, devalue your currency. That's all nonsense. First of all, it's not good economics. You can lower your unit labor costs internally. You don't have to do it through cheapening your currency. In fact, cheapening your currency only gets you inflation. So it's bad economics. But apart from that, if you look at opinion polls, forget about politicians, but look at what the people of Greece, Italy, Spain, Portugal say. They love the euro because they know that if they went back to their old currencies, the governments would devalue it and steal their savings. So the people like the euro. Germany likes the euro. Germany's providing the leadership. I like to say that Merkel is the only head of state who understands economics because she's not an economist.
That was author, economist, and boom-bust all-star Jim Rickards. Time now for a very quick break, but stick around because when we return, RT correspondent Manila Chan is sitting down with me to discuss the downward spiral of Atlantic City. So here's the question: can the once glamorous, who doesn't love Boardwalk Empire, glamorous gambling destination regain its glory days? We're going to look into it coming right up. And it's the end of the week, which means we're bringing you the best of the very best from this past week. Plus, remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and on Hulu, hulu.com/boom-bust. Now we got to go, but before we do, here are a look at some of your closing numbers at the bell.
It was a terrible mistake, and we're working very hard to make up for it.
And once again, to put something on the air, it's a flat-out lie.
Have you ever had sex with Governor Rickards?
No, wait, do not answer that.
I want you to watch what we're about to do because you've never seen anything like this on television.
What we need is to question more and to keep it uncensored, real and raw. My simple mission is to change the globe. I'ma do it with this passion and fire and tone. These ones are hard hitting, you're watching your neck, but you need to tune in because we're breaking the set. Breaking the set. Breaking the set.
Welcome back to the show. Now, in 2012, Atlantic City welcomed a new $2.6 billion hotel called Revel. Revel was supposed to usher in a more opulent era for the East Coast gambling destination, but sadly, that didn't happen. And after failing to find a buyer in bankruptcy, Revel announced this week that it'll be closing its doors on September 10th. Revel is just the latest casino to fold in AC. Both Caesars and the Trump Plaza Hotel and Casino will be shutting their doors as well. The closings are expected to leave the already struggling city in shambles, with up to 8,000 people left unemployed. And here to discuss is RT correspondent Manila Chan. Manila, thank you so much for being here. And this is good stuff to learn. And AC, not very far from here in DC. So let's get to this. Now, I want to ask you, it looked like Revel was great. Everything was going well. There was no reason for it not to work. But it just didn't turn a profit. And in fact, Morgan Stanley, they were willing to take a $1 billion loss on this, just right off, just to get out of their position. So why was Revel not as successful as anticipated? Did it have to do, with timing, the recession? What was it?
I think it's a little combination of all of those things. The timing was in part, and we'll get further into that as we talk about, as we know, Sandy.
Right.
But let's start first and foremost with really bad feng shui.
Okay.
And not to be talking about design, but really when it comes to building a casino, you need to put the casino where it's accessible. Right? This casino is on the 3rd floor. It's 6 stories above the ocean. So it's really bad feng shui. So the gambling area is really just inaccessible for people to go in and out. And
that's really fascinating, because you hear, like hotels, they spend so much money on feng shui experts for their lobby, how a lobby's so integral to the success of a hotel or some sort of establishment. So I'm sure with casino, it's even more important, because that's where you need to make your revenue from the gaming.
Now, I don't know if this is what they intended to do, but they have kind of a vertical build. Revel is built vertically. I mean, the hotel tower is actually the tallest structure in Atlantic City.
Okay.
It's the 2nd tallest in the entire state of New Jersey. It sits at 57 stories, and it's actually the second tallest casino tower in all of the U.S. So, I mean, even taller than some in Las Vegas.
Fascinating.
So maybe they intended to build vertically, but that did not.
It just didn't work out.
It didn't work out
now,
because the floors are wrong.
Can you tell me about Sandy? You mentioned Sandy before.
Yes.
And I mean, superstition, it's big with gambling, and Sandy hit 5 days after the opening of Revel. That is some bad timing.
Right. When you're building a casino, I mean, superstition is part and parcel to the business, I would say. I mean, there's just some things that come with a certain line of business, and superstition, I think, has a little something to do with this. So after Sandy, the entire boardwalk suffered. I think we can all attest to that, right? But not only did Sandy give an ominous sign to begin with, before the resort even opened, they had a crazy string of horrible incidents that happened. I mean, check this out. Okay. Early in the construction phase, 6 key executives were traveling to Minnesota for business stuff for Revel. They chartered a plane. The plane crashed with all 6 executives on board. So if you're into superstition, this is pretty dangerous.
That's
July 2008.
That's crazy. I want to ask you about this, though. BLS numbers came out, and second quarter numbers were better than expected. But this is the 4th casino to close in New Jersey, particularly Atlantic City, and I believe that they only have 12 in total. So they're losing a lot of jobs, like I mentioned in the open, and a lot of this. So, how will this affect New Jersey's fiscal situation right now? It seems pretty dire.
It's very dire. I mean, between, like you mentioned, the Trump Plaza, that's closing. Between Trump and Revel alone, that's more than 6,000 jobs that are going to go away. So you got to think about the economic impact there of the people that live in that town, the people, property values are going to drop. That's one thing we can look at. Property values are going to immediately drop because the people that own homes or rent properties there, they got to look for jobs somewhere. They're going to leave the state. Meanwhile, Pennsylvania is actually picking up the gambling slack. So I think a lot of people are probably going to leave New Jersey, the people that are losing their jobs here, and probably run over to Pennsylvania. But then you look at mom and pop shops, kind of like the dry cleaners,
vendors that were used by these casinos.
The guys that bring the Coke cans. I mean, all these other side suppliers that people don't tend to look at when you think of a casino. You just think, people going to gamble. And
but it's good that you bring up the gambling aspect, because Moody's, they recently downgraded the debt. What was it? Excuse me. It was $245 million in general obligation debt for Atlantic City, and it's downgraded to junk right now. So they said their primary reason for doing this was that the #1 driving force in Atlantic City was gaming, and now gaming's going away. So is there anything that AC can do moving forward to basically diversify, not become so reliant on gaming?
They're trying really hard, Atlantic City. They're trying really hard to try to compete with Las Vegas, but I think Las Vegas has kind of got that that gambling aspect tied
Right.
down. So for Atlantic City, I mean, they really, I think personally, I think they need to move into turning it into a more family-friendly area, as well as maybe even convert some of the properties that are there that are currently existing, like the towers, and maybe turn them into like vacation rentals, or maybe even luxury housing. They need to make it a place for people. They need to go through the rezoning process.
Right, just
Chris
pivot.
Christie really needs to knuckle down and look at other avenues of bringing long-term revenue to the city. Because gambling, I mean, you're just not going to compete with Las Vegas. You just can't. Atlantic City is beginning to crumble.
Right.
Meanwhile, Las Vegas is continuing to build.
Right, yeah, that's interesting. You know, it used to be, I read in 1988 that AC was the #1 summer destination that year, and now it's going away. So if people are still gambling, even though
Absolutely.
you know, we're feeling the after effects from the recession, but they're back out there, and Vegas is growing. So
And
it's
not only Vegas, I mean, AC has to compete with all the Indian casinos that are opening up in New York, in Pennsylvania, in Florida even.
Manila, I'm so sorry. We got to have you back on to talk about this, and I know you know real estate, so we'll talk housing
Yes,
soon. That was RT correspondent Manila Chan. Time now for the best of the very best from this past week. It's the end of the week, and that means it's time for our best of the very best segment. Now, first up, we have William White, chairman of the Economic Development and Review Committee at the OECD, and he's giving us his take on quantitative easing and whether there's truly a trickle-down element to it. And to tie up our first week of Black Hat interviews, we'll see what cryptologist Bruce Schneier has to say about NSA surveillance. Next up, computer security analyst Dan Geer tells us what he sees for the future of internet confidentiality. And to top off the segment, security consultant Kate Pierce is giving us her take on the efficiency of data mining in light of all the controversy surrounding mass surveillance. Enjoy.
I think the real problem, Aaron, has been that policymakers, bankers, regulators, politicians, versus virtually anybody you want to think about who has been a party to what has happened up until now. I think if you accuse them of short-termism, it would be an accusation that I think the judge would say is an appropriate one. I think there's far too little thinking about the longer-term implications of what's happening. And that's one of the reasons why I'm sort of sympathetic to the BIS's arguments about, is it time to pull the plug on quantitative easing and all the rest of this stuff? Because my sense, and I think the BIS's sense, is that the positive benefits being derived for aggregate demand are going down over time, whereas the unexpected and undesired consequences, medium-term consequences, are going up over time. And these two functions cross at a certain point in time, at which point you have to conclude that the policies are doing more harm than good, and we should think seriously about stopping them.
Data mining is actually not a good tool to find terrorists. And the problem is we're looking for extraordinarily rare events in a massive sea of communications. And whenever you have those sorts of systems, false positives completely overwhelm anything you're finding. We see that in the United States, the data we know. We know about different NSA programs that send tens of thousands of tips to the FBI. All of those were false alarms. There are programs that try to find suspicious events. All of those are false alarms. The Boston bombers, now the NSA had data about them in their database. They didn't know they were more important than the millions of other people in the NSA database. Data mining, just surveilling everybody, is not a cost-effective way of finding terrorists because it's too easy to hide in the noise. What finds terrorists is following the leads. The things that have been successful for the NSA are when analysts go with a known thread and follow it. Who are their associates? What are they doing? That's how we stop terrorism. It's not broad surveillance. It's pinpoint targeted surveillance, the kind of stuff you see in the movies, right? Following the leads.
Frequently right now, most focused on issues of, roughly speaking, confidentiality. data breach, privacy, et cetera, that might all be collected under the word confidentiality. Going forward, it could well be that we inadvertently, or maybe just by deciding, oh well, give up on confidentiality, but integrity is then the big issue. And with medical records, I'd really rather that the average person not modify mine. And electronic health records already sell for more on the black market than credit card records do. So it's not as if this isn't something for which the first glimmers can be seen. Or for that matter, the integrity of configuration for all the things that we rely on being automatic. You know, I spoke a little bit about liability, but part of that has to do with the do you or do you not assume things go badly, and if so, do you have a way to cope with that? It might well be that integrity is the new thing.
There's a big risk with data mining where if you look back at the data you had, you can see how you could have found something, the Monday morning quarterbacking, but that doesn't mean your choice was wrong at the time. So is it the best way? I don't know that it is a good way. I don't know of any better ways. But I don't like it. More people to work on more data is a key part. But the problem is that everyone has their own agenda, and whether it's one massive organizational agenda or a whole lot of balkanized agendas, you've still got an agenda. You still have to prove your worth and prove why you're there. And in the classified space, where you can't be accountable to your populace just by the nature of your work, that's different. Because what your agenda is, that can't be transparent to your people, and often it can't be transparent to your politicians. And that, I haven't worked out how to reconcile that with the idea of democracy. I'm a Kiwi. We had a similar thing when Kim.com went down a few years back, where it turned out the government was surveilling him and they should not have been. People got really, really upset. And so now they've changed the law so they can do it. Retroactive.
That was Boom Bust's Best of the Best from this past week. And that's all from us for now, but remember that we love hearing from you, so please check out our Facebook page at facebook.com/BoomBustRT. And you can also tweet at us at Aaronade, at EdwardNH. From all of us here at Boom Bust, thank you for watching. We'll see you next time. Bye-bye.
With